The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. And thanks for joining us here for Market Talk today as we take a recap of Friday's market action and really the trade for the week. It was a kind of a deja vu day Friday with the grain markets finding some good overnight strength and then kind of falling back in the day session. The soy complex, though, did its best to try and trade higher on Friday's session. Joining us now for a conversation as we recap the week in the trade, Ted Seifert, Zaner Ag Hedge is with us. Ted, welcome back to the show, buddy. Good to catch up with you. How are you?
I'm doing well, Jesse. Thanks for having me. How are you is the bigger question.
Little sleep deprived, but that's to be expected. And I have not bought any stock in Folgers coffee quite yet, although I've been toying with the idea here this week, Ted.
Huggies, Pampers, and Gerber. Go for it.
Pampers, Gerber, and Folgers. That's the three buys I have. That's my recommendation for today. Oh, man. No, things are going well here, though. Thanks for asking. Good. And I appreciate you joining us here to round out another week of the trade. And let's start with the soy complex. That was our area of strength on Friday. I was kind of curious your thoughts of what we might be seeing in this soy complex overall, because really the last couple of sessions we've kind of backed off the most recent rally here and kind of moved this market lower, but beans finding a little bit of support at least to end the week, Ted. So let's your thoughts on that a little bit.
Yeah, absolutely. A couple things there. Soybean oil had a very strong end of the week last week, and then really fell flat on its face when it wasn't part of the new tariffs announced on China. But then it managed to recover fairly well towards the end of the week. And part of that is because the crush came in well below expectations. Therefore, soybean oil stocks came in below expectations. And that sort of saved that soybean oil chart a little bit. And now it kind of seems like soybean oil may have put in a near-term bottom, which goes along with the fundamental change in having less stocks than expected. And so that's been helping the soybean complex out as a whole. However, it does really feel like there's something going on with soybeans themselves at the moment. And it does feel like it's happening in the old crop. It's really been July that has been the strength. The July-November spread has moved out pretty well here over the last couple of days, while that July contract has been very reluctant to go down and has been, really the strength of the grain complex as a whole. And Brazilian premiums are firming. We haven't seen a daily flash sale in a couple days. We did earlier in the week with 160,000 of new crop, which was nice to see because we have virtually nothing on the books for new crop. We keep seeing people post on Twitter the analysts, Karen Braun, for example, and Susan Stroud, talking about how we have the lowest amount of new crop soybean sales on the books in the last 19 years. For this time of year. And that's a growing concern. But then you've got July soybeans finding some strength. So, definitely feels like there is a global end user, possibly China, possibly other countries, possibly a combination, that are looking at booking or have been or looking at booking some soybeans up front. And if that's the case, Jesse, I don't really feel like this is a long-term thing for soybeans, but it is very interesting. The spreads have turned a little bit more bullish. The charts, again, we really kind of saved them at the end of the week for the soy complex. So I don't know. We'll have to see how this unfolds. You could also say that it might be tied into the potential for planting delays when you look at the longer-term forecast. You really got the feeling this week that the planting delay concerns kind of fell away from corn to an extent and really maybe shifted over to soybeans. And export market and planting delays might be related. It could be that global end users are looking at that longer term forecast saying, oh no, maybe that soybean crop doesn't get planted. Maybe we need to come in and get some needs filled in the near term, just to sort of hedge against some issues later on. So, there's a whole lot of things to be watching right now. I think this week or the last couple of weeks, we've had a whole lot more going on in the market than what we've had for a little while. And when you have multiple things to be watching and paying attention to, and really a lot of uncertainty, Jesse, that's when things get interesting in markets. And it's generally a positive thing for prices.
A lot of uncertainty, especially I think surrounding China. You know, we got those tariff increases by the Biden administration here this past week. And I've said this, I'll ask you, I'm a little worried because the minute I think about tariffs on China, I think about retaliation on US ag products like soybeans. We're already running at a deficit and we have a lot of beans here in the US on hand. Are you worried about maybe any retaliation by China, or they maybe stepping in here ahead of something like that to book some beans, Ted?
Yeah. Okay. So that would be a very obvious explanation as to why China is out, or why China would be out sourcing as many beans as they can right here and right now. So that certainly might be the case, Jesse. And you look at Chinese crush margins, similar to our domestic crush margins, they're not great. So it's not being driven financially, if that's the case. It wouldn't seem to me. So yeah, that could be a big clue. That being said, and without getting too terribly political, I also get the feeling that China would prefer to have more Biden, right? And if that's the case, they might not really want to explicitly retaliate or do anything to hurt Biden's image, although I think when you talk about the constituency and who's voting for who, I don't know if it would really matter. So I don't know what Chinese political motivations are, or how that part of it works. What I will say is that I think very clearly they are fighting a silent trade war with us. Whether they actually put tariffs on agricultural products or not, I don't know. But it does feel to me that they've told their state-owned buyers that, hey, stay away from the U.S. as much as you possibly can. And I think that's evident on our new crop sales sheet at the moment, where China has 0 on there. Now, there's some unknown. And judging by the round numbers of the unknownness, that is likely some Chinese activity, but maybe not the state-owned agencies. So, I do feel like there is this silent trade war happening. Now, whether it becomes explicit or not, I really don't know. But it really doesn't matter, at least in my opinion, right? It really doesn't matter until those sales start showing up on the books. And if I'm the soybean market, and markets always have a function. They're trying to accomplish a mission. It might be too early for this just yet. We might have to wait until after planting. We are still a ways away from even getting into the next marketing year, the new crop marketing season. But at some point, what might have to happen, Jesse, is we might have to go and find a price where we find that export interest, whether it's through China or other countries coming in fairly aggressively. But we got to fix that new crop sales number. And if that is the case, if and when that has to happen, beans might have to just, take 20 cents off and then see if we get any business. Take 20 cents off, see if we get any business, and rinse and repeat until we start getting that new crop soy export sales schedule a little bit more robust than it is right now.
Ted Seifert with Zaner Ag Heads joining us here today on Market Talk. Ted, let's shift gears over to corn and wheat, and maybe start with corn first. It feels like that rally has really kind of faded here in recent days, and now we're kind of back near some support levels in corn. I heard a lot of talk of farmers selling, a lot of orders working right below 5 on D's corn, things like that. Your take on this corn market and the pullback we've seen here to round out the week, Ted?
Yeah, what a difference a week makes, Jesse, right? I think at the end of the day last Friday, after the USDA WASDE report, that was, I'm going to say, less bearish than expected for corn. And in the face of planting delays and everything like that, I think everybody was really getting pretty bulled up on corn. And then we follow that up with a week where we were down about 18 cents. Wow. And like you said, really challenging some very key support levels at the end of the week there. That if they fall, then the corn chart all of a sudden looks like it wants to go and test lows. And so, what is that all about? I'm also going to throw in the NOPA crush number that we had in the middle of the week. I know that we switched to the corn market, but that has an impact on corn because with the crush coming in 20 million bushels below expectations for the month of April, that also means less meal, and that also means less feed competition for corn. So between that less bearish than expected new crop carryover, old crop carryover, overall report for corn last week, and with the idea that maybe corn demand is actually looking positive going forward, as opposed to the conversation we just had about soybeans, I think there are reasons to be a little bit friendly corn. Yet again, we've responded with a rather heavy week, and I think part of that is because I think the trade remembers 2019, and we got the corn in. And if we did it in 19, I think we'll do it again this year. And I think the trade's feeling more comfortable about that corn getting planted. I think there's going to be a lot of corn that got in from the middle of this week and throughout the weekend. I know some areas had just not been able to catch a break and still got in the rains, but the areas that did get missed, I think are going to be running as hot and heavy as they possibly can. And we might be surprised by how much progress we see when we get the progress report on Monday. And again, I think the market's sort of reflecting that. So I don't know. Longer term, I do still feel a bit more friendly on corn prices as a whole. But also, when you talk about a potential 2.1 billion bushel carryover, while it's not as bearish as what we were originally talking about or thinking, especially when you go back to the Ag Outlook Forum, that was almost a 2.4 billion bushel carryover. Mm-hmm. And it's not that much worse than this current carryover. It's really about the same. We're basically saying right now that the corn situation is going to really be almost identical year over year. It's not in a territory where you can say, well, these are bullish numbers, right? We are in a position where we would like to grow demand or continue to grow demand a little bit more. We'd love to get that carryover down to like a 1.6 to a 1.8 billion bushel carryover, which means price rationing isn't something that needs to happen for corn. And it actually leans towards the side of, hey, we can maybe go down and tempt some demand at some point. So even though that WASDE report, that new crop outlook, wasn't as bearish as originally thought, it doesn't necessarily mean that we have to go higher, and it actually could mean that we still do need to go down and see if we can entice some more demand.
I think corn and wheat too have kind of been tied together here as of late. And in terms of the wheat market, I know we got the Kansas Wheat Tour, found a pretty decent average yield, 46.5 bushels per acre this week. And I know this wheat market, a lot of the move recently has been tied to the weather concerns around the world, particularly in Russia. Here's the thing though, Ted. I mean, it's Russia. Are we ever really going to know what is going on with that wheat crop in Russia here?
Yeah, it's never too late to replant wheat in Mother Russia, apparently. I don't know. What we also have been hearing is that on-farm stocks in Russia are really, really high. So, it's kind of one of those things where, all right, even if there are issues, you're right, we might not know about that, because when the wheat comes to market, it might just be coming from on-farm stocks. But then again, how true are those numbers? I don't know. The fact of the matter is that Russia has been exporting a whole lot of wheat. We're talking records. And it's hard to get really, really bullish about that. And then you look at our domestic balance sheet, and the projection for new crop carryover is expanding by about 100 million bushels. So getting a little bit more bearish. The only thing that you've got is that the global carryover for countries that aren't China and really just major exporters is one of the tighter ones that we've seen in a while. But we've started this way kind of every marketing year when we're looking into new crop, or before we even get into the marketing year. And it doesn't get worse. It actually ends up getting a little bit better. So, I don't know. I have a hard time really getting terribly excited about wheat right now. It has had a really nice run off of lows. When we talk about short covering and fund short covering and all that, it's been the wheat. It's happened to an extent in corn and soybeans, but it's really been in the wheat. And so I think that was justified. I think something like that needs to happen. It's very healthy for a market to have a cleanse like that. But do I have any good reason for wheat prices to continue to go much higher from here now that fund short covering has likely been completed? I really don't. Does that mean that we have to go down and make new lows, though? I'm not really on that I'm not really on that boat either. But maybe what we've done is just defined a range that we could be trading in for quite some time now, Jesse. And you go back to the 15th, 2 days ago, as Wednesday, I guess, where, we made a new recent high. It was a new high for the year. I mean, you got to go all the way back to August of last year since we were at that price level. But then we completely fell on our face, reversed, and ended up closing below the previous day's low. Now, that is not technically a key reversal because it wasn't a new contract high for that July Chicago week. But a lot of people would call it a key reversal because it was a new high since August of last year. It certainly was a new recent high. And when you reverse and close below the previous day's low, that's a big red flag on a chart saying, hey, this move might be coming to an end. This is a very toppy sort of look to a chart all of a sudden. It doesn't always mean a chart, but it's definitely a red flag. It definitely can give you the feeling that, something might be happening. This might be close. And we've responded by being down the following days, even though we've tried to go higher. So like you said, try higher early, and by the end of the day, we're giving it up. And that has very much been what's gone on in the week. It has alleviated the overbought condition of the market. We're back to about 60% on the relative strength index. But I don't know. I think the rally in wheat has happened. I don't know if we need to extend it much higher. I'd actually be kind of surprised if we get a solid close above that Wednesday high. But like I said, I don't know if it's going to be a fall out of bed, break down to the lows again either. I think we've defined a range here for the time being.
Ted, I want to make sure I ask you about the stock market as well. The Dow eclipsing 40,000 for the first time ever, and pretty much holding there as we round out the week. Your thoughts on some of that activity in the outside markets and how that is or is not playing a role in grain and livestock trade?
Well, it certainly plays a role in livestock trade. When you have strong stock markets, you feel pretty warm and fuzzy about domestic beef demand, especially for the higher cuts, and you've seen that reflected in box beef values. I mean, being back to the levels that we saw at the end of March when we were still trading decent prices before we started dealing with bird flu. In the live cattle charts, feeder cattle, they've responded to that, and they've pretty much done the same. So there's optimism about renewed optimism about domestic demand for beef, and again, that's happening both in the cash market and on the futures board. So that has something to do with it. The strength in the stock market is very much tied into the idea that hey, inflation was a little bit less than expected. This is going to open the door now for the Fed to come in and lower rates like they have been saying they would. And the trade feels like pretty certain that that's going to happen. I don't know if I would do that, Jesse. If I'm the Fed, I think I'm leaving rates unchanged at least through the end of the calendar year. Inflation is not something that just goes away easily. I think that you'd want to have these lower readings for quite a while before you're comfortable with really lowering. So we'll see. We'll see if this is just sort of a stock market euphoria that doesn't come to fruition or not. But either way, I mean, look, we joke about it all the time. There could be a headline of a nuclear, holocaust, something like that, and I think the stock market would go higher just because it's factored in, or whatever. I don't know. The stock market just seems to want to go higher. And look, in a broader conversation, we can say, hey, that's in itself a reflection of inflation. Either way, it to your original question, it has a big impact on the livestock market for sure, in particular the beef market and cattle. It does have an impact, I think, on grains too. When you have things going really well in the stock market, you don't have quite as much of institutional interest in trading commodities because these guys are doing really well in equities. So I don't know if you'll have these, larger, record short positions or even long, or the size of the fund positions might not get to be as big. And that might just ultimately mean less volatility, which, by the way, I'm not terribly happy with. And that's simply because of the time of year, right? Getting into a weather market, we're going to have that volatility anyways. So does it need to be extreme? Well, no, maybe not. So who knows? Any of that can change on a dime. So stay tuned. We've got I think we're going to have a very active next few months in the trade. There's a lot more to talk about today than there was a month ago. And I think that sort of thing is going to continue.
Well, Ted, good stuff. We're up against the clock. If folks want to reach out to you and talk about the marketing plan and more there at Zaner Ag Hedge, what's the best way to reach you?
Absolutely. You can reach me directly, 312-277-0113. You can also find us on the web at www.zaner.com. I'm doing an afternoon commentary that you can sign up for. It's 5 to 10 minutes, just kind of run down on the markets. We've got actually a number of different things that we've been rolling out lately. So check us out there. And then if you have time and Twitter or the X is your thing, I am at the Ted Spread.
Again, you can find more information, Zaner.com, or find Ted on X as well. And with that, Ted Seifert, Zaner Ag Hedge, thanks for joining us. Have a great one. We'll talk to you again soon.
Hey, pleasure's mine, Jesse. Thanks for having me, and hope you get some sleep, brother.
Going to try my best to get a little bit of sleep. That's Ted Seifert with Zaner Ag Hedge joining us here today on Market Talk.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.